The Australian share market has been caught up in panic selling, recording its worst fall since Donald Trump's Liberation Day back in April last year, wiping $70 billion off the market value in one day. Investors across the globe, in fact, headed for the exits, and I'll speak with NAB Trade Director Gemma Dale shortly to find out why. But first, let's look at the numbers. By the close of trade on Friday, all sectors were lower. Tech was off 3.3% here in Australia. The ASX 200 index slumped 2%. The All Ords was off 2.1%. Today's worst performer was Web Travel Group. It was down almost 30%. That's after the company revealed tax agents are auditing its Spanish subsidiary. REA Group also lost ground because it says it's seeing a decline in the number of property listings on its website realestate.com, but it did post higher earnings. Uranium miners were also sharply sold off given their relationship to energy requirements in the tech sector. Rio Tinto was flat after the miner said it's abandoned merger talks with rival Glencore that would have created the world's biggest mining company. In fact, just 5 out of the top 200 stocks closed the session higher. For the week, the ASX 200 index lost 1.8%. The All Ords fell 2.3%. Bitcoin has fallen back to where it was in November 2024 when the pro-crypto Donald Trump won the US election. Bitcoin has in fact crashed by around 50% from its peak back in October last year, on Friday afternoon trading at $63,000 a token. And the big local economic news this week was the RBA's rate hike, which has taken the cash rate up to 3.85%. The RBA governor has been defending the decision before an economics committee in Canberra, saying inflation has been more persistent than expected. But Michelle Bullock says things could have been a lot worse.
In many ways, the position we're in, although everyone's talking about it quite negatively, it's actually quite positive. The reason we're in this position is because the labour market is still doing really well. And it's stabilised, at a relatively low unemployment rate. This is good news. And I think people sort of forget that. Okay, we've got inflation still a little bit high, so we've probably got to work on that a bit. We think there's some temporary factors in there, but we think there's a little bit of persistence. That contrasts with some other countries, and I'd probably speak about Canada and New Zealand here. They took interest rates much higher than us. They got inflation back down, but they've both got very high unemployment.
And now back to that major market sell-off. I spoke to NAB Trade Director Gemma Dale about why investors are exiting everything all at once. Gemma, it's been a week. It's been a bit of a sell everything. What do you make of it?
It's been pretty extraordinary, as you say, and it's worth noting, it's not just the sell-off, it's the fact that we've had a rate increase in Australia, we've got reporting season, there are just so many variables, physical metals going absolutely wild, all of the things that tend to happen at different times have sort of converged this week. I think in some cases, a lot of things have run very hard. It's worth remembering during Liberation Day, there was a very aggressive sell-off and then just an extraordinary run, and a whole series of things have run very hard. They don't tend to run very hard together. So when we've seen physical metals, gold and silver running hard together, that's fine. But you don't anticipate that happening at the same time as the Nasdaq, the same time as the S&P 500, the same time as, so there's just been this incredible convergence of things performing relatively well. After what was pretty catastrophic economic news, even though a lot of it was sort of resolved or settled into sort of vague uncertainty. And now perhaps markets feel that it's time to take a bit off the table.
And you mentioned silver, that's seen double-digit falls daily this week, and gold is also down. The US dollar strengthened a bit. Is that fed into the sell-off?
It's a really interesting one. I think it is primarily the fact that they both run so hard. It's not surprising. I think most people feel that gold is absolutely in a long-term uptrend. It had just traded sideways for a long time. The drivers for the uplift in gold are there. Central banks are buying. Portfolios that just had no or very limited exposure are now being rebuilt around a sort of core holding, and that's a huge uplift at a global level. So I think most people feel that it's real demand for gold. Silver's a little bit more speculative, and that has been historical, so we tend to see far more volatility in silver. So it took longer to catch up, and then it ran very hard. You would anticipate pullbacks in that environment. I think the US dollar had been hit a little bit, it's come back a little bit, it's less correlated.
And when you're looking at silver, do you see it as highly correlated to that gold story? You said it was more speculative.
It tends to be more speculative holding, if at all. A lot of people will have a standard gold holding and have had it for decades. It did drop out of favour, to be honest, as things got financialised and we moved towards ETFs and portfolios that could be held digitally and so on. Gold just lost of its luster, no pun intended. And then we've seen people move back to it. Central banks obviously doing a huge amount of the buying, but a lot of very significant asset allocators as well. So investment banks, family offices, big portfolio holdings, moving back into gold and trying to build those over time. Silver just tends not to hold that place. People are happy to have some leverage to it, but it's just not quite the same. So you tend to see a lot more movement in the price.
And speaking of financialization, I mean, Bitcoin had a huge run up in 2025, but it really has lost that Trump rally benefit, if you like. It's back to 2024 levels.
Yeah, so Bitcoin's an incredible one. I think the real challenge for the true believers is that most of the stated benefits of Bitcoin, either as a diversifier or as an alternative to fiat currency, is it hasn't held up very well against those things. It hasn't been a great store of wealth, but there has been this issue of financialization. So we now have Bitcoin ETFs, we have a lot of leverage and derivatives into Bitcoin, and because you've got these instruments that leverage the Bitcoin price and can influence it, a lot of the true believers and those who have cold storage or just have it sitting in a wallet are not necessarily the ones driving the price at the margin. They're a little bit shocked by what's occurring, maybe out of their hands.
Well, we haven't mentioned tech stocks yet, but that has been the big story of the week. I mean, at the end of the week, it was really the capex or the investment that big companies like Alphabet and Amazon were planning. I mean, Alphabet doubled its capex plans, and Amazon upped them by half. The shares fell.
I don't think that's hugely surprising. I mean, all analysts were factoring in fairly enormous capex expenditure, right? We have seen this for a long time. Everyone's very familiar with how huge the build out is going to have to be in order to really win the AI race. And it's become a race. It's very clear from the announcements that are coming to market and some of the showcase. Anthropic obviously had their solutions in market earlier this week, and it triggered a massive sell-off because people believe that's the future. It's that huge capex that makes markets nervous. Are you going to be a winner? Are you going to be able to monetize this? That expenditure's huge, and if it's bigger than I expected, but you're not showing revenues, we're going to get a little bit nervy.
It's interesting though that it was Amazon and Alphabet because they're really big, giant, profitable companies.
This is true. There was a fairly broad consensus early in 2025 that Google was going to be one of the big losers of AI, that search was going to die and that AI was going to replace it. And then we saw a turnaround later in the year when everyone went, wait a second, they do have extraordinary exposure and potential in this space, and they started to deliver on some of that. The story changes a lot, right? At this point in time, it's very difficult to pick a winner. All we know is there's a lot being spent, there's a huge amount of potential, and we are seeing some incredible gains being made in some sectors. But it's not clear yet who's going to be the final winner, and I think markets are getting a little bit nervous about the amount of money on the table.
And you mentioned Anthropic, and of course that Claude, the updates to the capabilities of that program really put fear into the market around the software stocks and the viability of their revenue streams. Is this an ongoing story, do you think?
I think we're going to continue to see questions asked in this space. You know, SaaS the software as a service concept has been one of the huge winners really of the internet boom, the second internet boom, not the first one, not .com, the second one. And we've seen just this incredible growth in these software companies. You've got, frankly, highly profitable licenses, incredible network effects. The power of these companies has been so extraordinary, but the idea that you can recode these things with AI and replace them internally, the potential for that to completely disrupt revenue streams and do it very, very quickly is making markets uncomfortable. It's worth noting that a lot of stocks have been trading on extremely high multiples and well beyond their sort of long-term averages. And so there are some that are coming back hard because they have just run very hard, but there is this clear concern, and I'd say this domestically as well, because we saw WiseTech and Xero get sold off really hard too. There's just concern that the potential for disruption is very high.
And I guess in Australia we have a relatively small tech sector, so we haven't seen it impact our market as much. But the big domestic story, I guess, was the RBA's rate hike. It was expected, but the outlook looks like, at least in NAB's view, that there's another one coming.
Yeah, I think when we say it was expected, most economists had to change their view through 2025 from expecting a number of cuts to a number of increases. And that was a pretty dramatic about-face, to be frank, and it started sort of later in the year. So yes, it was expected, but most of the forecasts were changing sort of in the last quarter, and then this is really the first opportunity for the RBA to hike, and here we are. We're absolutely expecting one more increase at this point in time. It is a big shift for markets to price in that amount of change when we were going from significant cuts to an uplift, and we're seeing a bit of a turnaround.
Yeah, and I think it's probably a fairly big shift for home borrowers as well. But what about the Australian dollar? It was up at 70 US cents, but it's back down now to the 69 level, even though the rate outlook is higher.
This is true. I think it's worth noting, as I said, though, that forecasts were increasing through the last quarter. So we kind of saw this one coming. It's not a huge shock to the market, and we didn't see the dollar jump dramatically. Also, these are relatively small hikes. We're talking 25 basis points, obviously, this week, and the expectation is for another 25 basis points. We're not talking, 100 basis points and a huge differential to the US. Also, some concerns about whether or not we will see massive cuts in the US, which were previously anticipated. So it probably just explains a slight shift in the dollar.
Gemma Dale, always great to talk to you. Thank you so much.
Thank you for having me.